Portfolio Builder members, welcome to our Emerging Markets Trade Alert. Our goal is to deliver retirement income from China and its main trade partners through a group of ETFs. This is traded every Thursday at 11 Eastern with a video and written instructions, which is what we're looking at. And we roll over this position every Thursday. So US, China, announcing that they are coming close to a trade deal, but it will take until 2025 to be completed and reach its goals. So interesting. U.S. stock market flying up. What is the emerging markets betting on? And it's not quite the same picture in the emerging markets. So after covering our positions from last week, we are sitting on a 5.2% return. And now we'll issue some new covered calls. They're going to be very defensive this week. As you can see, we had to cover most of our positions for a loss on the covered call, but that means we've won on the underlying asset appreciating. So once again, we missed out on some of the gains, but made a nice solid return consistently. And our goal in this program is not to outperform the market, but rather to mute the market's volatility, to reduce risks of losing capital, and to generate a consistent return. I think you'll see in the long run, it's very hard to outperform this strategy and have a feeling that you can sleep safe at night. The new positions today are summarized in this chart, and you can see that we are riding in the money covered calls once again, which benefits us the most if we trade flat or slightly down from here until next Thursday. The only exception is the precious metals market has become bullish on gold and still flat on silver. But meanwhile, the option volume, as we'll see, is flowing into the put options this week, which really begs the question as the legitimacy of this trade deal and what effect it will have on the emerging markets. So in our webinar in 2 hours, I do have some more slides that are not included in this video, where we'll get into some of the problems with the global economy. But namely, it is a lot of housing bubbles around the world are really showing a lot of trouble. So let's look at the option volume. Emerging markets, huge volume pumping into the put option market. The biggest volume is at the 43 strike. We chose the 42.50. So if everyone has to cover at 43, it may flatline right around there if this prediction is right by the options market. There's a little bit of bullish sentiment buying this 45 strike, but once again, things just aren't adding up, and I'm still somewhat skeptical of a bear market in the U.S. only lasting 3 months and being completely over now. In the same breath, the global markets were in a bear market for all of 2018. So if the global market's really slowing down and going to potentially crash lower from here, will it drag the U.S. down? Or are we really at the end of the latest recession and going to start pumping more money and have a continued bull market? So time will tell. Our program is always going to play it safe, take small returns, and have lots of protection. If we go to FXI, the large cap Chinese companies, a little bit of a spike from this morning, but nothing like the U.S. equities market. And you can see a huge amount of volume buying the 44.50 put option, 117,000 shares. So that is quite incredible. And there's absolutely no call options being sold relative to that volume. So I chose the 43.50 strike on this position. And again, this is one of those cases where we might make a little bit of money if the market goes up. However, if it goes flat or down, between our strike price, we generate the best return. South Korea, highly tied to the Chinese market, obviously. Not a lot of option volume. We chose a 61.50 just to play it safe as it's so correlated to China. And then the Indian stock market is really on a rip this year from 30 up to 35. They have high interest rates at their central bank, unlike the rest of the world. So it's a very attractive place to invest money right now. Its trading volume is low in the options market at this point in time. We wrote the in the money or at the money 35.50 strike, as that's probably one of the few that we can easily get filled on. Russia, we did the at the money 21 for 29 cents. Same thing, low trading volume, so we're just going close to the strike price to make sure everyone can get filled easily. Brazil has turned relatively bearish today, as you can see, but leading up to this point in time, it had a lot of open interest at that 43 call option. So once again, to play it safe, we wrote the strike way down at the 39.50, below where all these folks would have to cover. So gold, we can see some option volume this morning at the 23.50. We grabbed that 23 strike. And silver, still not really reacting much, not a lot of volume. And we chose that in the money strike. So that's the trades for today. A quick explanation of how you use the spreadsheet. You have 3 tabs at the bottom of your spreadsheet. This is the emerging market strategy. So I've hit all the tabs except this. First step is to put your deposit in the blue area, which by default will start with 50K. Then make sure you have the right settings up here, which is defaulted at 17% steady income, 55% high yield, 3% cash position, 20% gold, and 10% in a OTC stock, 10 cent, which is one of my favorite Asian companies to invest in for the long term. They own Fortnite, Clash Royale. They're starting up a product a lot like Netflix for Asia that's called Start, and they own a ton of stuff. They're a huge, fast-growing Asian company, and they're issuing a $6 billion bond. So they're going to continue grabbing up everything they can get their hands on. So the first step is to insert your deposit you want to trade with in this portfolio. So you might modify that if you want more or less. If you want to turn off any section in here, it's color coded, so you could turn off the 10 cent position and put more capital into emerging markets. If you really wanted to simplify this and start off with only about $4,300, you could put 100% at this setting and turn off all the others. And then you'd just be doing one covered call on the Thursday class, and then perhaps you're doing the rest of your trading either on Tuesday with our high yield covered call program or our Monday, Wednesday, Friday SPY/TBT trade. So after you have figured out how you want to allocate your capital, you have to make your purchases. You get a trade alert right here telling you how many shares. Remember, we're only buying multiples of 100, and that's because we're writing covered calls, protecting our capital, and generating retirement income. Now, if you're a younger gentleman or lady who is more interested in growth, these exact ETFs are the same strategy I would recommend to a younger fellow. Just drop the covered call. You're going to see a lot more volatility, but you're going to capture the big gains over time. As we know, the balance sheet and the monetary supply is only going one direction, straight up. And sure, there are slight pullbacks when the banks try to reduce their balance sheets. But what do you get? You get a 2018 bear market in 98% of all asset classes. It'll probably be a long time before they try to do that again. And so when we look at the way the world works, there's going to be a lot of money printing and a lot of asset inflation. So once again, these are very well chosen palettes to build your portfolio with. And the only reason you do the covered call is if you're going into retirement, you can't afford the volatility, you can't afford a decade of losses. And so with the covered call, if the market goes flat or down, we're going to do extremely well while everyone else is panicking and losing money. So in a bull market, we may look like the stooge or something of that nature. But when the market goes bearish or even just flat, we'll be cranking in the same consistent profits, whereas everyone else is losing. So you keep track of your open option positions that you're writing or selling right here. So these are our current trades. This ROI is a little misleading. This is the return on investment in the covered call relative to the price, but I did write the price slightly below. So keep in mind, our true profit was sitting at, I believe, 5.2 or 8. After writing the covered call, it inflates our return on investment. So after we cover these next week, I'm sure that we most likely will show an incremental profit, which is our goal, but it won't be doubling our return in a single week. So that's something just to keep in mind. Now, as we close the positions, we enter them down here. So you just literally copy the ticker, the date entered, the expiration date, the strike, the option price start, and then whatever you close it for. And I want to point out that when there is a, oops, that was a typo. When there is a negative return on the covered call, that doesn't mean we lost money. That actually means our underlying asset has gone up in value. So when you read a covered call portfolio track record, you should actually be more concerned when there's a lot of big returns. Like this set right here, that's 96%, 92%. What happens to get a high return on the covered call? It means the underlying asset either went flat or down. And so that does not tell the whole story. And in fact, we would rather have negative losses on our covered call for all of history and just let our underlying asset appreciate, because we have a guaranteed profit baked into the cake every time we write a covered call. We can only lose if the underlying asset goes to zero and never comes back. Otherwise, we can keep writing the covered calls, generating income, protecting our assets, and slowly but surely grow a portfolio. So this launched on 12/13/2018 during the Christmas massacre, just like the rest of these portfolios. And it's a good way to diversify a lot of your cash out of the States. The largest money manager in the world, BlackRock, is basically calling it the quits for the US market and is putting all of its energies into bringing in clients to the emerging markets. Not only to find clients from the emerging markets, but to bring all the American capital, and I think they manage some $6 trillion, to start flowing it into the Asian markets. So that's the big story. That's why you want to have some capital here in the emerging market portfolio. Most likely no more than 25% of your capital should be in this portfolio at this current time. And so that's our update. Hope you can make it to our webinar in a couple hours. I will have some other unique slides not covered in this video, and we'll do a Q&A and see if we can't demonstrate how to launch a portfolio from scratch with a live audience member. So thanks again, and look for a new trade alert tomorrow.